Hey guys, thanks for joining us today. We're going to really get into something super, unique, something that I'm sure you've never heard before. Well, we're talking to one of my longest term friends, longest term clients, has raised, I don't know, Eric, what have you raised? 100 million? Two?
Yeah, probably around 500 million in equity from 2009 to present.
That's it? You bum. So no, I'll get a little bit more into your background in that, but I'd like to kick it off with a few stupid jokes for you. My financial advisor asked me, "What's my net worth?" I told him I don't have a net. Here's another just stupid dad joke. My financial advisor said I need to be better with my money, so I fired him.
That's good, Nate.
I know, just pure ridiculousness. But no, better introduction. Please welcome Eric Mattingly. And thank you so much for joining. God, I don't even know how many deals we've done over the last decade and a half plus.
Close to 100.
Time flies when you're having fun. You had more hair when we got started, and I had less
Yes.
gray when we got started.
Yeah, and what I do have is gray.
And congrats, you've only raised $500 million in equity. That's pathetic. I don't even know why we got you. Just joking.
Well, not by myself, but just collectively as a company.
And your company is what?
DMI Holdings. Our website's investwithdmi.com.
Absolutely love it, and thank you so much. And of course, I'm Nate Dodson. I'm the principal over at Crowdfunding Lawyers. We do help syndicators, sponsors, the management side, doing the capital raises, acquiring businesses, acquiring real estate, starting up companies. And, we're going to be talking very specifically about the sales process today. Eric's going to share a little bit of his secret sauce, one of those things that you just don't see very often. And, if you are interested in getting a little bit more information kind of about how to do deals, how to structure them, how to get them launched. We're really focused right now on the sales process, but let me just share this real quick. This is a QR code. Go ahead and you can scan it. It will take you to a free download, kind of a securities instructional manual. We'll drop in chat the direct link as well. But just to kind of share, hey, get some more information, learn how to raise capital legally, the safe, the smart way. And without further ado, Eric, I gave a little bit of a background. Is there more that you'd like to share and
Sure.
just about your background? And then we'll get into the presentation.
Sure. Well, first of all, Nate, I appreciate you inviting me on here. And, as I shared with you the other day, I'm really kind of at a place in my life where I'd like to, help other syndicators. Over the years working together with you and, Nate's been a mentor to me and really kind of helped me learn how to put deals together and how to do it correctly and all the compliance aspect. But there's also absolutely a sales aspect. And I've been in the private capital industry since 2006, started DMI in 2009. So I kind of got my first exposure to capital raising through being in the oil and gas business. I went into that business actually to learn how to raise capital and thought I was going to also learn how to put deals together. But it definitely got experience talking with investors. I had been a real estate investor for a number of years, just doing single family homes. And my friend that owned the oil and gas company said, if you ever want to do anything on any significant scale, you need to learn how to work with investors and be able to put money together. And so after I learned what I needed to learn, I didn't like the industry and the results, but for the investors. And that's when I kind of went off on my own and started DMI. I had, met Nate kind of along the way, and we became friends right away. And once we started really launching DMI, Nate was just really instrumental in, advising us all along the way and partnering with us on things. And so I appreciate all the help and guidance and mentoring you gave us for sure. It definitely learned a lot from you, from really just how to do deals and what you got to watch out for and things of that nature.
I truly appreciate it. And I'd love to ask you a question just because you brought up, you started in oil and gas. And I know selling oil and gas is different than selling a startup. It's different than selling a real estate deal. Could you speak a little bit to just in general, like you're trying to close one type of deal versus the other type of the other? Like,
there's a huge difference. In the oil and gas industry, the people that invest in oil and gas, the most of the investors we work with today don't invest in oil and gas. And the biggest difference is people that invest in oil and gas are making an emotional buying decision versus an intelligent investment decision. And it's just it's a gambler type person. You're telling these people you can lose all your money. It's only for big boys, and the more you tell them how risky it is and why they shouldn't do it, oddly enough, it would make them want to do it more. It was just I really didn't understand it. In my time that I was there, the company that I work for, I think they've probably done several $1 billion in projects, and maybe only a few of the wells actually paid out. ROI, it can mean a couple of things. In the oil and gas business, it's return of investment, and in the investment industry, it's return on investment. So that's another big differentiator. You're really getting your money back out of a hole in the ground if it's able to even do that. And there's so many challenges and problems along the way. I just never saw any investors have success with it.
So that's an emotional sale. Buy now, you lose the opportunity. You potentially got 10x. You potentially have losing everything.
Yep.
How's that compared to like a business startup?
Well, it's similar and it's different. We haven't done a lot of true just startup like angel investing type of things. We typically would look for companies that had an existing track record, a location or two, and wanted to open multiple locations. So they wanted to expand, focus on operations. We're looking for an equity partner, and really, at least you have that to go off of. Past performance doesn't dictate future results, but if there's nothing there, all business plans look good. And all the projections look good. That doesn't necessarily mean that you're going to meet any of them. It is very speculative. However, at least if you have a business that's operating one or two locations, you can make an evaluation based on what they've actually done, and then the business plan, and then the projections. And you just try to make it as conservative as possible and put in your own assumptions that dumb things down, because the business owner is always going to be generally more aggressive. And so there's certainly more risk investing in a business if there's no real estate involved than there is investing in a real estate opportunity.
But where you're saying the oil and gas is more emotional, if you had a tag, like, is it more analytical or a slower sales process?
I think it's a little bit of both for a person that's going to invest in a business. So we do business expansion opportunities. We don't do startup business opportunities. So, people are going to, it's really kind of the same type of investor. They may just not want to invest quite as much. They're going to, quite frankly, they're looking for the upside. So their investors are expecting larger returns. They're going to evaluate the opportunity. If the business is local, a lot of times we'll do, facility tours to give them an opportunity to see it. If not, we usually also do virtual tours, similar to like a real estate home. You can walk through, to get a general idea of the quality of the business. More importantly, I think the thing that they're looking at really is, because we're not the operator, we are always the equity partner. We partner with an operator. So the operator is a big part of it, really understanding what their background and their track record is, prior experience in the industry. So it is, I think, a little bit of analytical evaluation from an investor standpoint. And I mean, we invest in all of our own projects. So, I mean, it's the same thing that I'm looking at. We try to convey the same things that we look at to the investors. And then it's the excitement that, a business could be highly successful and there's a huge opportunity for kind of a big windfall or an above average return on investment.
All right. Well, let me ask you about the other asset class that has been a big focus for a lot of us.
Mm-hmm.
Acquiring real estate, specifically multifamily, but there's been all different types of deals. What's the different spin or considerations thinking about real estate with a hard closing date versus the business versus oil and gas?
Yeah. I mean, I think you and I have probably done, 30 plus multifamily deals together and more offerings than that. Some of the projects we did had more than one offering, but multifamily for me is probably my favorite asset class to invest in personally. I personally invest. The thing that I really like about multifamily and investors like, we try to keep it simple, and I don't have a slide deck to work with today on it, but there's some fundamental real benefits to investing in multifamily. So just kind of high level, in a multifamily investment, provided you're in a normal interest rate climate, we do both value add acquisitions and new construction. We've done more of the value adds and then we have new construction, but we've had good success on both. And with a value add, you're going in and there's an opportunity to bring value by reducing expenses and increasing the income. The value of the asset is based on the income that is being generated versus single family, where it's based on comps, what people are willing to pay in any given market, just the buying and selling activity that's going on. Multifamily is based on the income. So if you can increase the net operating income, you can increase the value, which really gives you a lot of opportunities. Generally, the business model on a value add would be a 5 or a 6 year business plan hold. Or at least that's the target to be able to return investor equity. Normally, you would do that in about a 3 year period of time and refinance. Ideally, you can return about 50% of the capital. Sometimes it's less. Sometimes you can't refi. Sometimes it's more. We had one project, if you recall, on Enclave. It returned 100% of the equity, just a little over 5 years. We held it for 7 years. And investors had no money in it. So it's one of the unique features is that you can wind up owning an asset without an investment of cash due to refinancing and loan proceed distributions to return investor equity, still get tax benefits, still get cash flow, and then have an upside. So the projects that you're able to pull all the investor equity out, which might require a second refi or a supplemental loan, it makes sense. You don't have any money in the deal. There's nothing at risk anymore. Why not hold it longer term and sell it for a greater upside in 2021 and 22? Collectively, we had ownership in a number of properties that we held for that period of time, and investors hit a home run, sponsors hit a home run. It just, to me, plus you can create income. You usually don't have high income in the first couple of years until you hit that refi point. And then once you have some capital returned, your basis goes down, and then your return on invested capital at that time goes up. That's usually when a multifamily project is going to be able to get you in the double digits on cash returns, distributable cash.
Love it. And I know you're still doing some multifamily deals. You're still working with some investors. I know a part of it is always what's happening in the market. What does the crystal ball say? What's your thoughts? Just kind of what's going on today versus the outlook going forward?
Obviously, the interest rate climate has made things very challenging for multifamily investors. Last year, we did one new construction deal with a HUD loan at a low interest rate. no value add acquisitions of any kind. Sometimes the best deals you do are the deals you say no to. So you might look at 100 deals, and if none of them make sense, you need to say no to all of them, even though you might want to do the deal. And that's exactly what happened last year. I mean, it just, people that were selling, that were truly motivated, that had to sell, it's highly, highly, highly competitive. Everybody is just pouncing on these people because there's just nothing really out there that makes financial sense. So we elected to pass. And now we're seeing interest rates start to soften up. I saw one of your talks a little bit. You had kind of shared with your clients and database about where interest rates are going. So, as the interest rates start to come down, I believe there's going to be some good buying opportunities. But, right now we haven't got any new multifamily acquisitions or development projects, imminently impending. We're kind of waiting to see where interest rates go. We're also same thing with any refis. If we don't need to refi, we're not going to, just because of where interest rates are right now.
And I will say that, at least from the news and all indications, the Federal Reserve kept the interest rates where they have been with their last meeting, while making comments that they still anticipate reducing the interest rate 3 times in 2024. So I won't be surprised. Of course, they want to see as great an economy, as great as a market as possible, because there's elections happening this year.
Yeah.
So I love the forecast for 2024, just my own opinion. I will say that if they don't reduce it, we're probably going to see a lot more foreclosures.
Yeah.
Which, if you're getting into deals, it still creates opportunities.
Yep.
I would much rather see good opportunities because the interest rates come down, rather than the good opportunities because people are losing their shirt.
Yep. And some people are right now.
It's a tough market, but it's, at least in my opinion, definitely going to get better. So thanks for a little bit of that insight in the different asset classes and really what you've worked with in the past. I know you have, and I kind of thrown you in the fire.
Yeah.
This is about sales.
It is.
What to pitch, how to sell an investor, how to find those investors. And I know you've got a little presentation. Are you ready to kind of do a little bit of teaching?
Sure. Yeah. Again, just met with you the other day, and really kind of sharing, there's so many things that a lot of people don't understand, or misconceptions that they have. The syndication industry is a great business to go in, but, experience is really just somebody who's been knocked down a bunch of times and is still standing up. A lot of people that, just due to lack of experience, I think either don't have the success they were looking for because they were expecting something else to happen, or when problems come up that they didn't know were there just because of lack of experience. Really just the desire to try to share more and help to train and educate people that are interested in the industry, and as well as passive investors. You're either an active investor or a passive investor or both, and really just understanding just how the syndication industry works, what to look for, what to watch out for is important. So I've got a presentation I did, a short little presentation for another group that I'd be happy to share. Probably won't touch on every single slide just because of the time constraints, but I think you were wanting to focus more on the sales aspect, so I could focus a little bit more on that.
I absolutely love it. So if you share, I will bring it up and twiddle my thumbs while.
All right, so I just hit this present.
I think that's the way.
All right. Share screen.
And I got to admit, and I know it applies to both of us. We are horrible techies, and even worse as secretaries. It's comical. I figured out that I scheduled all these phone calls at 1 a.m., 2 a.m., 3 a.m. One of these days, actually gonna figure out how this works.
Okay, so I don't know if I'm doing this right. Let me pull up this presentation and see if y'all can see it. Can you see that?
We see it great. Yep. We see it just fine.
Okay, so let me go full screen on this. All right, so Nate, can you see that? Because I can't see you right now. Just making sure.
We see the screen just great.
You see the PowerPoint?
You got it.
Okay, so syndication training. So I put together, just working with investors over the years, I put together a workshop series really just to kind of help train and educate, really more than anything, just passive or general investors. This one I put together to help people that are interested in the syndication industry. So this is one of our wealth building strategies workshops, but is geared towards syndicators. I think we already kind of went through my background, so I won't cover that. A little bit about DMI. We mainly are equity partners with an operator, and we offer passive investment opportunities to individual accredited investors primarily. These are a bunch of multifamily deals we've done, Class A, B, C, a little over 7,000 units. We've also done a variety of other types of projects, which are kind of referenced here, and a few business expansion opportunities, as well as some opportunistic assets. So we've done, more than just multifamily, but multifamily we focus on. So just raising capital. Well, and some of the stuff I might skip. So Nate is really on the SEC rules and regs, so we won't cover any of that. The marketing and
that subject. So
yeah. The marketing and packaging is important. We won't, I'll just touch on it because a lot of people have some misconceptions about that. And then the sales piece, how to close, where to find investors, and just the art of selling. So capital raising, I got news for you, is sales. It's not just electronic marketing. Shared that with you guys already. So who are your investors? They're your network of people, friends and family, friends, business associates, their networks as well. And then what I always have trained our sales team is, just start with your cell phone. You have a lot of contacts in your phone, and you can start networking through that. And that's how I started. And we grew to, I didn't even get all the way through my phone. And then we started meeting so many different people just through networking that I didn't need to continue doing that. Who your investors are not. This is important, I think, for syndicators because, you get these big, these people start talking big money and we want to invest less than, $20,000, $30,000, $50,000. So your investors are not family offices, hedge funds, private equity funds, venture capital firms, pension funds, real estate investment trusts. You can sell to some of these groups when you sell a property or a business. They are not your source of capital to go fund your PPM. Broker dealers, we used to have a branch office of a broker dealer. Nate helped us to organize that and oversee those operations. There's a few different deal structures. And the thing that I would tell you, and I'm not going to spend really much time here, but the simpler it is, I used to come up with these, all these creative ideas, and Nate really kind of helped to rein us in. And these are kind of the most common deal structures that is easy for an investor to understand, because a confused mind says no. If you create these weird, complicated waterfall structures, nobody's going to invest with you. So straight equity split is very common. We do that a lot. Normally, if we do a straight equity split, we're going to put a performance hurdle on the back end. So at the time the deal sells, the investors need to hit at least a minimum baseline return. We usually set that at 10% to protect their downside because of no preferred return on the front end. You can also just offer a fixed preferred return. So you might offer no equity, but maybe you're going to give them 10 or 12% on their money. That's an attractive option. It also doesn't hinder you when you're getting debt. Because it's not a loan loan investment that you're structuring. And then you can do a lower preferred return plus equity. If we do a pref plus equity, we don't put a performance hurdle on the back end because they're going to get preferential treatment on the front end. They're going to get their pref with 6% or 7% or whatever you do. Plus, you can offer lower equity. And so being able to explain these to investors is important, because if they don't understand it, they're just going to default to saying no. You can do it as a loan where you just offer an interest rate. You can do an interest rate plus an equity kicker. So maybe you give them a 10% interest rate plus a 10% participation in the deal as a way to give them some upside. We've done that a lot, mainly with bridge lenders that help us on the front end to close on a project. Or you can do a waterfall structure, and Nate can advise you on that. So just kind of going into the marketing, what we do to market to investors, you do want to present yourself as professional. You want to have a professional email draft that somebody says, well, yes, send me something on your investment. You're going to have an email draft that goes to those investors. Make sure that you have Nate's office approve all your content. We do a little investment summary. Some investors, if you're an engineer type, you want to read the PPM. Normally readers don't buy and buyers don't read. We do have readers that buy, but some people just want to get straight to the point. Hey, don't walk me through your whole pitch deck. On one page, what's the deal? And so we do a one-page investment summary. Sometimes it's 2 pages. If Nate gets a hold of it, it turns into 3 pages because you got all the disclosures and stuff you got to put in there. But really 1 or 2 pages to kind of explain the deal. Extremely helpful, especially if you know somebody's hard to get a hold of. Doctors, for example, they're very, very busy. They don't want to talk to you for a long time. They want to just look at it, understand it, and make their decision. We still do a comprehensive business plan. Most people, quite frankly, don't look at it. And we don't walk people through it. It's there for them to read, not to explain the investment. Then obviously you have the private placement, operating agreement, subscription agreement. Top two questions new syndicators usually ask: where do I find investors and how do I get them to invest? So that's kind of what we're going to touch on here briefly today. You do have to be a good communicator. So, there's an art to investor communication. More than anything, this is the number one thing that will get investors to invest. They are going to need to know, like, and trust you. So just a couple of components of this. Selling is a transference of feeling. So you've got to be comfortable and natural and convey your enthusiasm about the project that you're going to present them. If you're not excited about it, an investor is not going to be excited about it. You have to be confident. So you need to know the deal inside, outside, upside down. You've got to be able to handle questions, but at the same time, you also don't need to know everything. I get asked questions by investors all the time that I don't know, and I'll say, hey, great question. Let me get the answer for you, and I'll get back to you next. So you need to be enthusiastic. You need to listen to what the investors ask, a lot of questions. The questions you ask give you the information that you need. So you need to really get to know your investor. Don't just pitch them your deal. I can tell you before I even send somebody an investment opportunity, I'm going to get to know what it is that they, where they are financially, what kind of investments that they're currently in, what are their goals and objectives. And if the investment opportunity that we have isn't in line, like for example, if somebody says, I only want to invest in things that have cash flow and we have a land deal, I'm going to tell that investor, well, the opportunity we have isn't going to produce cash flow. It's designed to produce a capital gain at a later date. That doesn't meet your cash flow objectives. Are you still interested in looking at something like that? So, you don't just try to force it on them. And if they say, no, that really doesn't meet, well, you just saved yourself and that person a bunch of time. And listen, be a good listener. Listen to what they say and pay attention when they're telling you about themselves. People like to talk about themselves. Ask a lot of questions. They're going to give you the information that you need. And raising capital, really, it's a relationship business. It's not an electronic business. It doesn't mean it can't turn into any electronic business. So finding investors. So there's a few components to that. Prospecting you can do by cold calling. Warm market, those are the people in your phone. Networking events. Where you specifically go to an event where you think the people are interested or meet the objectives of what you're looking for as an investor. Center of influence networking. For example, if you have a doctor that you're speaking with, and let's say they're the head of a anesthesiology group or something like that, that is a center of influence. So you build a relationship with that person first. Once they're comfortable with you, and especially if they invest, then you have the ability to network with their network. Referral marketing. So anytime somebody invests, we always want to ask for referrals. The majority of your business will come from referrals. So that should represent 50% or more of your business is from referrals. And you got to have an elevator pitch, just a really brief overview and explanation on what you do. Normally, when you, if you want to give your elevator pitch and you ask somebody, what do they do? They're going to tell you. And in most cases, they're going to turn around and ask you. And then based on what they tell you will dictate whether I even give them an elevator pitch. If the person is a manager at, McDonald's, nothing wrong with that, but I know he's not an investor candidate and he asked me what I do, I'll just say, yeah, I'm in the private equity business, cheers. And, I'm not going to try to intrigue the guy. However, if the guy says he's owns a construction company and and you're going to assume he's an accredited investor, you want to have a brief, couple of sentence pitch. I'm in the private equity business. We do multifamily business expansion opportunities. We typically try to we have an investor network. We generally try to hit our investors, a 10+% return on their money. Anyways, hey man, do you have a card? Just real brief like that to pique their curiosity. Work smart, not hard. The cold calling is hard work. It works though. It's hard work, but it does work. Once you have initially gained that interest, you need to set an appointment with this person so you can actually have a real conversation with them, get to know them, and ask them some of the questions that we covered on the previous slide so that you can see if they're even a fit. And then you can set an appointment by phone. You can also do it in person. You can also do through webinars, obviously. And this has been a huge game changer, really. So, it really is an instrumental tool to be able to kind of meet somebody face to face without having to drive somewhere. And that's been a big game changer. So then you are going to present your opportunity. Once you've gotten somebody interested, you sent them an email. You're going to maybe just do a brief walkthrough. You can do an in-person presentation if you get together with them in person. And you can do that conversationally. You don't have to do it where you're walking through a slide deck, but you also can walk through a slide deck. Number one strategy really to get an investor, I would say 8 out of 10 investors, if you have an investment opportunity, a property or a business or whatever you're raising capital on, that you can actually take an investor personally to that location, walk them through, meet the people that are there, that work there, and actually get to see it. And if you qualified them on the front end, your closing ratio is about 8 out of 10. So 7 or 8 out of every 10 people that take the time out of their day to go drive to your property, meet with you and see what you're doing, will wind up investing with you if you know how to follow up. Zoom meetings and webinars. If you do a Zoom meeting or a webinar, you always want to record it because you can circulate that to people that weren't able to attend. Also it allows the people that were to review what was done before if they didn't get an opportunity to watch it. We also generally will include not only the recording, but the slide deck that we went through so that if they just wanted to flip through the slide deck and not listen to the webinar again, because maybe there was a page that they didn't really get any time on, then they have the ability to do that. That's very effective. And then, like my partner Leon always says, I call him the AT&T guy, you got to reach out and touch someone. You have to reach out. If you just send an email and you don't actually communicate, you're not going to get the results that you're looking for. You need to talk to these people. They're going to forget that you sent it. They're not going to get around to it. So you need to set a follow-up and communicate. Ask questions, be yourself, and let them get to know you. That's how you gain rapport with somebody. People are going to invest with people that they know, like, and trust. So it's important that you have that rapport, because if they don't feel connected to you in some way, they're probably not going to invest. Some selling rules of thumb. So a lot of times you might get on the phone with somebody and then they want to start telling you about their life story. Well, when you've set the appointment to explain the investment opportunity, you need to control and direct the conversation. So, stick to the point, listen to whatever they had to say, and then get right to what you called them for. Otherwise, you'll wind up talking about a whole bunch of personal things. They'll run out of time. It really just kind of interrupts the flow of the whole purpose of the conversation. ABCs. So always be closing. What that really means is it's not like a sales tactic. It's as you're going through explaining the investment, what I usually will do is ask them, do you understand that? Does this make sense to you? And if they're saying yes, it also let you know if they don't understand it. And that's really just getting them to agree and say yes throughout the information that you're sharing so that you know that they understood it. And then at the end of the day, it's going to come down to, do they trust you? Are they comfortable with the investment? FBC is fact, benefit, close. So when you're talking to investors, you want to use facts about the investment, what the benefits are about those facts, and then close could just mean, does that make sense to you? Or would you feel comfortable doing 50 or 100,000? So that's another strategy. And then EEC, enthusiasm, empathy, and confidence. We kind of touched on that on the other side. If you're dry and monotone and you're not excited when you're talking to them, they're not going to be. And you'll lose people just because of that. So if you aren't excited about whatever it is that you're doing, you don't need to be raising money for it. And if you are, you need to make sure that whoever you're talking to, you've shared that with them by your tonality and the way that you talk and the confidence that you have. Sometimes people say no because they don't have enough information or they just don't trust you. So just because somebody tells you no doesn't mean that they won't invest. There's one of the corporate sales training books is Green Eggs and Ham. That's actually a sales book. It's not a kid's book. It was written for kids, but it's used in corporations to train their sales team. Sam I Am asks that guy to buy Green Eggs and Ham 12 times. Successful salespeople will go past 6 no's. After 12 no's, which is what the Green Eggs and Ham, if you go past 12 no's, they're not going to buy. I can tell you personally, I'm not going to go to 12 no's, but just understand that just because somebody says no, that doesn't mean that they're actually not interested. They just may not understand all the benefits. And if it's suitable for them and it meets their objectives and they say no, it may just mean that they, A, don't understand it or that they don't trust you. And that's something that you have to earn. And then if they say yes, that makes sense. I'm interested in investing. You're done with your presentation. Stop talking. At this point, they're ready to do the paperwork. They don't want to talk anymore. They don't need any more information. Don't take that away from them, waste their time and yours. That you just need to help them do the investment at that time. And then a few closing strategies to share with you. Now, there's tons of these. And, and I use closing, really, it is a sale. You do have to bring the sales process to a close, whether that is a yes or whether it is a no. And there are strategies behind how to communicate effectively on the sale that you are trying to make, because that is what you are trying to do. No matter what it is that you think you're doing, you need somebody to write you a check. That's a sale. So these are sort of the most common and effective strategies. The 10% rule is one of them. So normally, and this is a mistake a lot of people make when they're trying to have an investor make an investment decision. If your minimum investment is $100,000 and you're talking to somebody with a $10 million net worth, just as an example, that $100,000 may not even be worth them doing the paperwork. So normally, no matter what our minimum investment is, before they ever see anything, I understand generally what their net worth is. And so just using the $10 million example, what I will usually say when I begin the presentation is, based on me understanding where you're at financially, really the most we would allow anybody to invest would be up to about 10% of their net worth. So in your case, somewhere between $500,000 to $1 million would be suitable for you if you're comfortable with that. I don't have them thinking about they might ask me what's the minimum, but I'm not going to talk to them about that. You might get somebody to invest $500,000 just because you didn't tell them what the minimum is. So the 10% rule, highly, highly effective. I strongly recommend that you do that. You can always, they might ask, well, hey, what's the minimum? It's $100,000. Did you want to do 100 or would you feel more comfortable with 250,000? That's the alternative choice close. So giving somebody 2 options. So I would start with the 10% rule, go through the presentation. Are you interested in investing? Yes. So where would you feel more comfortable? Did you want to do 500,000 or are you comfortable with $1 million? Well, what's the minimum? Oh, the minimum's 100,000. If you want to do something less than kind of what we talked about, maybe you would be interested in like 250 investment. And that's the alternative choice close. Also very effective because it allows them to make, I pick option A or I pick option B. Don't use any open-ended questions. What are you interested in? That's an open-ended question. Would you be interested in this or that? That's a closed-ended question. The favor close. So this is a strategy that really works, I think, more with people that are already investors. So this happens, anybody that raises money, you're going to get stuck and you're going to have people that are invested. You got another $1 million left. And so a very effective thing is to go back to your existing people that invested. And if it's suitable for them, you can call them and ask them to do you a favor. Hey, listen, we're down to this last $1 million. We're kind of stuck. We're really trying to minimize the number of investors that we have on here. Could you do me a favor? And maybe you got 100,000 in it. You know, it's suitable for you to go up to 250. Would you mind taking another 100,000? That's the favor close. Super, super effective. Another example of that is, let's say the investor says, you know, what's the minimum? It's 100,000. Can I do less than the minimum? Well, let me check. So yes, we can go ahead and do you a favor, especially as a new investor. We are willing to allow you to do 50,000. That's also another example. The odd lot close. This also, I don't know why it works. I think it's just a psychology thing, but this works with a new investor. It also works with a existing investor. Maybe you're going to go back and ask them if they can do you a favor. And because maybe somebody had some odd amount. If your minimum investment's 100,000 and you have 75,000 that's hanging out there to close the project, it's not the minimum investment. It's not an even number. And that's the odd lot close. So presenting an odd dollar amount for some reason seems to be very effective when you're working with investors, whether it's an existing client or if it's a new investor, especially. Hey, normally our minimum's 100. We have we had a guy that invested 125 out of an IRA. We have 75,000 odd amount. Would you want to do that? And so that's also very effective. And the takeaway close, and again, you don't make up things. These all have to be real situations. They're not just techniques. You base them on actual events. So an example of a takeaway close is you've been talking to this guy. You've had contact with him a few times. And as you've been communicating, the funding continues on. So now you're down to the last 200,000 or 300,000. This guy's been talking about 100. So that's when it would make sense to call that guy back and say, hey, listen, you and I have been talking several times now. You seem to be interested. You're definitely suitable. But man, at the point we're at right now, there's only $300,000 left. So I just got to ask you, you got to kind of either be in or be out. So by tomorrow or the next day, we're going to be fully funded. Did you want to go ahead and take the 100,000? And that's about a 50% of the time they'll go ahead and get off high center and make the decision because now the opportunity isn't going to be there, but it has to be legitimate. And then there's the last one to discuss here is the story or the situation close. And this is really just sometimes you do have a situation, right? But just calling somebody and trying to pitch them again. And sometimes it's hard to come up with, God, I've talked to this guy 3 or 4 times or gal, what do I say when I go back? And the situation might be that you have this odd amount and you might combine it with like a favor close. You call the person back. Hey, listen, we've been talking for a little while. We got a situation right now. We had a guy, we're down to the last end of the funding. So there's your takeaway close. This guy did 125,000 in his IRA. We have this odd amount. I was wondering if you could do me a favor and so there's your odd lot close and take this last 75,000. It's less than the minimum. I know we were talking about 100,000, but we have this odd amount in there. I'd love to do business with you. So really going back with a story and about whatever situation you're in, as long as it's legitimate, it's very effective. And so with that, I will stop my sharing.
I really appreciate you kind of hopping into that. I don't know, your camera is not on, so we lost you.
Oh, sorry. Hold on. See if I can lost connection with your camera. Oh, here we
As
go.
previously mentioned, we are horrible secretaries
There we go.
and as techies, the worst. Well, thanks for diving into that just a little bit more. So many people I got to learn how to raise capital, and that's marketing, that's strategy, positioning, branding, and sales.
Yeah.
If you don't have sales, you don't have investors.
Can I mention one other thing? I didn't mention in the presentation. It was more focused on the selling. Is you like just over the last few years, to be honest with you, we really even attempted and started any kind of electronic marketing and social media marketing and email drip campaigns. Like, we raised all of our money with what I just shared with everybody, without any of that stuff. We wouldn't even send an investment email draft with the information unless we're fully qualified. And so they were through relationships and communications. I think a big misconception and what causes a lot of people frustration, challenges, and maybe not to get the results that they were hoping to, is that they think that they're just going to go and start creating a bunch of doing a 506c where you can generally solicit and start posting your deals out there everywhere. And then you wonder why your deal doesn't get funded. Like, that stuff is more for awareness. And I say, once you have a, really established track record doing that kind of marketing, it is important you do that. Absolutely. And it needs to look professional. You need to be consistent, but it isn't what's going to raise your money. What's going to raise the money for whatever your investment opportunity is that you actually reach out and communicate with these people. You have to build a relationship. Now, there is a way to do that online. I'm not an expert at that. And what I can tell you is it takes usually a couple of years for people to really get to know you online versus you just reaching out. So if you use that and you see somebody that is, checked out your information, don't just expect them to send you an email saying, hey, I want to do $100,000. You need to reach out to them and let them get to know you, because they need to know, like, and trust you, whether it's virtually or in person. And if you want to cut 2 years down to a month or two or whatever, the only way you're going to do that is by reaching out. AT&T model, reach out and touch someone.
I think that's one of the most important comments you could ever give. Everybody thinks about crowdfunding. Hey, I can just throw something online. I can point people to it on social media. The reality is that's the marketing side, the awareness, the introduction to who you are and what you're doing, but it doesn't necessarily close the deal.
Right.
Two kind of different approaches that I do want to make a big point on. Eric, you're used to raising hundreds of thousands of dollars at a time. You have higher minimum investments. That has traditionally been how Regulation D works. Yeah. To differentiate just a little bit, we do have crowdfunding where you can raise smaller amounts from more investors. And if you're raising $1,000, $2,000, $5,000, $500 minimums, oftentimes, generally, you don't take the time on an investor by investor discussions. However, you have to be available to answer questions. Most of the time, these are done through investment portals. And with the investment portals, you can answer the questions right there, and then your answers are available for everybody. It can be done both in written form or video or audible form. At the end of the day, you do have to answer the investors' questions. But when you're looking for those smaller crowdfunding amounts, you don't want to go through this whole process, phone calls, spend hours each and every time. So we are absolutely talking about these Regulation D, $50,000, $100,000, $250,000 minimums. Just wanted to make that point as well.
Yeah, and just along that line, just because of what you just described, we've never tried to do any crowdfunding because, quite frankly, the investors that invest $250,000 or greater, you generally rarely hear from them. And the $50,000 investors, with a lower net worth, well, that's more in relation to their net worth, much less if you have it. So it takes a lot of time, right? It's usually you have to spend more time on those investors because of it's suitable for them, but it still means quite a bit. And so they're going to generally have more questions, especially if you have problems or issues or what have you. And if somebody had $500 or $1,000, we've never used that model. As far as portals, 100% you need an investor portal. There's a lot of them out there. I'll just tell you the ones we've used before is Syndication Pro. That's the one that we use now. They're not as good on the back end, but they're great on the front end. It's also helpful because you can set up co-sponsor portals under your portal if you're going to have people assist you in raising capital. And then IMS is another one. They're great on the back end, not as good on the front end. We actually use IMS only for their accounting, and we don't do any of our accounting through Syndication Pro, although they're good at handling sort of like your plain vanilla multifamily deals. But if it's anything more complicated than that, you know, and if you don't need a co-sponsor portal, well, then IMS is definitely better on the back end. And there's others out there.
And I think that's a great point. Honestly, probably 90% plus of the deals we represent, and we do hundreds and hundreds of deals per year, always are using investor portals. But there are different twists, turns, and benefits to all of them. So at least through when we're helping to develop a project, we're always making multiple introductions because you really nailed some back end considerations, making distributions and accounting versus the front end of the ease of investment. So really important things to think about.
Yeah.
We've got one question here. I'm going to propose it to you, and I've got my thoughts as well, but want to hear your thoughts.
Okay.
From James Ray. I've had several investors approach us over the last 6 months to create a fund or partner with us for multifamily based on our experience. Since they are coming to us, we'd like to include at-risk money in the raise. At risk meaning if it doesn't work out, you lose the money. Is this something that is done in multifamily?
Could you explain the question one more time, Nate?
So this is at least the way that I interpret it. Can you start raising capital, spending the capital on pursuit, earnest money, due diligence? If you don't close, you're going to lose it. Mm-hmm. If you do close, well, then it's just part of the capital stack.
Yeah, I'm sure your response will be a little different than mine, just more from the regulatory. But I'll just tell you, you know, whatever you put in your PPM and disclose, you can do. However, then, so even though it might be okay in the PPM, you also got to make some real intelligent decisions. So it depends. If you're an experienced capital raiser and you know you're going to raise a bunch of capital and you're going to put up earnest money and then it goes hard and then you don't close, you're going to lose that earnest money. You know, if you got enough capital in there, especially in a fund, in the grand scheme of things, it probably isn't going to make a difference in the returns to the investors unless you do that several times and then burn through a bunch of their cash. But on a development deal, you also have risk there because a lot of the risk is in getting the land, getting it entitled, and so on. So depending upon what you're going to do, you know, and then if you can't actually take it to the finish line, you burn through cash. So, yeah, I mean, if we don't know we're closing and it's time for earnest money to go hard, no, we're out. We want to get our earnest money back.
So, and to give the regulatory standpoint of it, most of these property acquisitions, we call them a conditional offering. You have no deal if you don't close. So if we're putting together a specific property syndication, that's conditional on closing. Generally, you can't use the capital to close. However, one thing that we often do, and you know what, because it does come up pretty often, we'll do one of these Facebook, YouTube live episodes on it. I call it Syndicate the Syndicator, capitalizing your syndication or your real estate company where those funds are very specifically used for pursuit capital, the due diligence, the earnest money. It ends up getting structured in such a way that you are recycling these funds where you can pursue the opportunities. You understand that it doesn't always work out. There are some financial losses, but at the same time, you get diversification because the investors participate in every deal this syndicator company actually does. So we do, well, it's important to have the at-risk capital. It's important to be able to pursue opportunities, but it's also more of a business risk rather than a real estate risk. And so we'll differentiate those between two separate deals.
Mm-hmm.
So that's at least my 2 cents on those. You know, Eric, thank you so much for coming today. I know that you're really focused on if you can help, if you can educate. Are you doing consulting or anything with syndicators or capital raisers?
No.
What are you doing nowadays?
Yeah, so no, we're doing less deals, and not at the moment, but that is something that I am probably going to start offering, because a lot of, there's a legal aspect. There's also putting the deals together, all of the business plans, some of the training, the raising of capital, and somebody needing assistance and guidance along the way. So I don't have anything formally organized, but it's definitely, I speak on the topic, quite a bit, not for money, but just because like this, just to share with other people, to help give them some information to help them out. But that is something that I'm considering doing, and I think I would really enjoy and be of value to other people, especially that are new.
So I don't know if you have or want to provide your contact information. We can link it. I don't know if you want to provide that right now, or alternatively, we can actually just make it available through. If you do, go to this QR code, go to the link. There's an information questionnaire. Go ahead and just ask for Eric's contact information. We'll include it in the information that we are going to provide with, we're going to post this later on. But Eric, what is the most direct contact for you if you want to share that?
So I'm happy to provide that. My email is eric@dmi-mgt.com. And then my phone number as well is 469-774-5425. That's my direct cell phone. And happy to help.
Love it. We've got 2 minutes left. I really appreciate you being here today. Do you have any final thoughts or anything you'd like to share with the masses? We had a few 200-300 people that have joined us today.
Just those of you guys that are going into the industry, definitely working with Nate and his firm is been instrumental for us. He's extremely knowledgeable and sophisticated. Definitely, if you're looking for somebody to kind of give you the correct direction and keep you out of trouble, you're with the right firm.
I truly appreciate you. And, I appreciate the friendship, the opportunities that we've created.
Likewise.
Between us for the investors and just making it happen each and every day. So thank you so much for joining us today.
You're Nate Dogg to me, man.
Love it. All right, my friend. Appreciate you.
Thank you for having me.
Thank you for joining.
Mm-hmm.